Hi there. In this video, we'll explain CIS payment and deduction statements and why they are important for UK tax compliance.
Missing a UK construction deadline by 1 day triggers an automatic penalty. Miss the 19th, the fine locks at £100, then scales to £200, £300, spiraling past £3,000. Crucially, HMRC doesn't require actual payments. The penalty fires even with zero financial transactions. Under the Construction Industry Scheme, or CIS, the late filing penalty escalator is the steepest enforcement mechanism HMRC uses outside of active tax fraud. The entire scheme operates on a rigid, highly unforgiving timetable designed to extract tax at the source from a notoriously transient industry. Success in this landscape depends on integrating these rigid reporting mechanics into every layer of your business operation. That level of precision is why Insight Engine has collaborated with Pro Tax Accountant, a specialist firm safely navigating UK businesses through high-risk tax structures. Today, we are answering one of the most critical questions in that compliance chain. What exactly is the Payment and Deduction Statement under the CIS, and how does it legally function? We'll break down the statutory rules, identify who falls under HMRC's jurisdiction, map the strict monthly timeline, and detail errors triggering heavy fines. The following breakdown will demonstrate how the Payment and Deduction Statement acts as the primary regulatory link between your business and HMRC. The framework operates on a strict legal relationship. The scheme governs contractors commissioning building operations and subcontractors executing that work. The CIS regime is strictly ring-fenced for self-employed and corporate subcontractors. Standard pay-EY employees are entirely excluded. But there is a hidden third category catching businesses off guard: the deemed contractor. If any business spends over £3 million on construction within a 12-month period, HMRC legally forces them into the CIS regime. Property developers, large retail chains expanding their stores, and housing associations frequently cross the spending limit without realizing it. Assuming the construction industry scheme is only for traditional builders is a compliance trap, leaving corporate financial officers exposed to multi-million-pound liabilities. Under the statutory regime, a CIS deduction serves as an advance, on-account payment toward the subcontractor's annual income tax and national insurance liabilities. The statutory calculation relies on a strict separation of costs. Deductions are legally applied exclusively to the labor element, completely isolating the cost of materials and VAT. Depending on how the subcontractor is registered, HMRC dictates the contractor must withhold either 20%, 30%, or 0%. Let's apply this to a practical case. A registered plasterer submits an invoice of £1,400. Materials cost £400, leaving a £1,000 labor charge. The contractor applies the 20% rate solely to the £1,000 labor block, resulting in a £200 deduction. The physical cash flow reflects this split. The subcontractor receives a net payment of £1,200, while the £200 deduction is separated and legally owed to HMRC. Failing to isolate material costs and applying the percentage to the entire invoice illegally overtaxes the subcontractor, violating the scheme's strict mathematical rules. This entire process is bound to a persistent monthly timeline. Every action a contractor takes must fit between the 5th of one month and the 22nd of the next. Step 1 requires the contractor to verify the subcontractor's tax status directly with HMRC before any funds change hands. Step 2 is the physical execution, withholding the funds from the invoice based on that exact verified rate. This brings us to the end of the UK tax month, falling exactly on the 5th. Step 3 triggers a strict countdown. The contractor has 14 days, until the 19th, to issue a payment and deduction statement to the subcontractor. A valid statement requires specific populated fields: the gross payment amount, the total cost of materials, the exact tax deduction, and the unique verification number. Step 4 shares that exact same 19th deadline. The contractor must file their comprehensive CIS 300 return to HMRC, detailing every payment made. Finally, Step 5 requires the contractor to physically remit the withheld cash to HMRC by the 22nd of the month if paying electronically. Manually tracking these dates across dozens of workers invites errors and administrative bottlenecks. Relying on cloud accounting platforms allows businesses to automate verifications and instantly generate compliant statements as soon as an invoice is paid. The Payment and Deduction Statement serves as the essential connective tissue of the entire framework. It is the legal receipt proving the math was accurate and the rigid timeline was met. From the subcontractor's perspective, this document is the only way to reconcile their tax position and recover the funds withheld by the contractor. This split flowchart illustrates the reconciliation process. On the left, individual sole traders use the totals from their collected statements to fill out their annual self-assessment, which frequently results in a direct tax refund from HMRC. On the right, the pathway shifts for limited companies. They input those same deductions into an employer payment summary, immediately offsetting the company's own internal PAYE and corporation tax liabilities. In either scenario, without the physical statements held securely on file, the subcontractor cannot legally prove to HMRC that the advanced tax was actually withheld by the contractor. At the close of the fiscal year, a complete ledger of payment and deduction statements is functionally equivalent to holding actual cash. Operating within this system exposes businesses to 3 severe administrative errors. The first is the nil return trap. Registered contractors who pay 0 subcontractors in a given month must still actively log into the portal and file a nil return. The second error is verification default. Guessing a subcontractor's deduction rate based on previous jobs, rather than actively querying the HMRC database, guarantees a compliance breach. If a contractor assumes a 20% rate, but the database required 30%, HMRC holds the contractor entirely liable. The business must pay that 10% shortfall out of its own pocket. The third and most heavily penalized error is employment misclassification. Treating a full-time worker as a self-employed CIS subcontractor to avoid paying employer national insurance contributions is aggressively investigated by HMRC. HMRC relies heavily on risk-scoring algorithms to actively scan the data in those monthly CIS 300 returns, specifically targeting businesses that display these mechanical reporting failures. The construction industry scheme is an unforgiving framework designed to guarantee the government captures tax at the source. Issuing and retaining accurate payment and deduction statements is a non-negotiable requirement for operating in the UK. Please note that this video is intended for educational purposes and does not constitute formal financial advice. Tax regulations require professional analysis. Whether you are a contractor trying to audit your own compliance timeline, or a subcontractor attempting to legally reclaim withheld deductions, resolving these issues requires expert intervention. Contact the specialists at Pro Tax Accountant directly. You can reach them by phone, via email at info@protaxaccountant.co.uk, or by visiting their website to secure your supply chain. Like this video and subscribe to the Pro Tax Accountant channel to ensure your business stays ahead of complex UK tax traps.